I'm pleased to be able to speak with Gary Hilton Stern, who was president of the Minneapolis Fed for 24 years. In fact, the longest serving president of any of the presidents in the Federal Reserve Bank system. And also, very importantly, a member of the FOMC. So we're going to use this conversation to discover a little bit how he thinks the system works, and from there maybe develop our own ideas about what we see happening today and the decisions that are being made today that affects the global economy. 24 years. Give us a sense of the Federal Reserve Bank system and how different the Minneapolis system is, or the Minneapolis Federal Reserve Bank is from, say, the Delaware or the Kansas or the San Francisco. What sort of issues do you focus on?
Well, there are a couple of things distinctive about the Minneapolis Fed. One is that all the Federal Reserve banks, one of the responsibilities is to understand the economy of your region, your district, and report on how the district economy is performing at the Open Market Committee meetings. Now, monetary policy is not going to be made on the basis of whether the Minneapolis district is doing well or not, but it helps to inform our overall view of how the U.S. economy is performing, and it also helps to give us a picture into, are there any special issues or problems that either exist or might be emerging. So that's one responsibility of the Minneapolis Fed, and it's a responsibility that each of the reserve banks carries out. I think that maybe the most distinguishing characteristic of the Minneapolis Fed is the high quality, really cutting edge economic research department it has. That's been in place for a long, long time. It predated my years as president, but it certainly continued through those years. It's a joint effort with the economists at the Minneapolis Fed, at the University of Minnesota, the University of Chicago, and some other academic institutions. And it means, I think, that Minneapolis has been able to make contributions both to macroeconomic research and to economic policy to a degree that far exceeds the size of the research department. And it also means that, you're not surprised by new developments in economic research because you have access to staff who really are at the forefront of that research. And that's very important in monetary policy making because you don't want to lose sight of the best approaches to understanding macroeconomics and applying them to real-world issues.
In that regard, when you think there's monetary policy, there's also employment. Are there tensions and dynamics that are different in an area like Minneapolis, which is different from, say, New York or San Francisco? When we talk about unemployment figures, I think that now that the Fed is actually publishing a lot more of its reports and the old ones are coming out, we get to see a lot more of the intricacies that you deal with. So there's no such thing as an employment figure. It's you drill down and you look at the quality of the employment figures and stuff like that. So how does that tension work out? And are there things in your turf that you look to guard against the national objective?
Well, the Minneapolis district, because I think of the composition of the labor force and also the composition of the industries and businesses that exist there, is typically a low unemployment area where you get significant divergences. I'll give you an example. If the energy sector of the economy is doing very well, then that means that Texas and the Dallas Federal Reserve District economy is going to, other things equal, be doing well. When the energy sector turns down, the Dallas regional economy will be affected. Now because there's energy in North Dakota, which is part of the Minneapolis district, that will be affected as well. So those pieces of information are well known to policymakers and are factored into our view of the economy. But you can't make policy based on something that's happening in Dallas and Minneapolis or New York and San Francisco. New York, obviously, financial services is very important. San Francisco, technology is very important, and so on and so forth. And, of course, the U.S. economy is pretty well integrated. So it's not that critical. one region may do better than another for a time, but not forever, because the economy is so well integrated. So we don't have a problem reconciling those kinds of things.
Right. Would you make a differentiation with the way the Europeans need to deal with theirs? I mean, theirs is not integrated, but somehow they are working towards a form of integration, and they're way further down further upstream than you are.
Well, I think there are at least a couple important distinctions. One is, I think the U.S. labor market still is a good deal more flexible than the European labor market, both in terms of geographic mobility, but also in terms of, letting people. There is no lifetime employment in the U.S. And so if your industry is shrinking, chances are you're going to have to find a job in another industry. Now, that can be harsh and that can be difficult, but it's to the long-run benefit of economic performance. So that's an important distinction. The other distinction, of course, is the United States has at the national level one fiscal policy, one federal government tax and spending policy. Europe doesn't have fiscal integration. Each country can pursue, to the extent that finances allow, it can pursue an independent fiscal policy. It can't, as we see with Greece and some other countries, you can't necessarily do that forever. But I think a lot of economists would say they need to harmonize or coordinate or better unify that policy. Now, it's easy for economists to say that. In the real world of politics, it's not so easy to achieve.
Right. But the U.S. has another element which creates a lot more depth and diversity, the municipal bond market, right?
Yes.
And we don't talk a lot about it outside the U.S., but every time you make a decision on rates, it affects all of the different provinces very differently.
It is certainly true that different parts of the country rely on the municipal bond market to a different extent, but virtually all states have balanced budget requirements. And what that means is, you can run a deficit for, a short period of time, but you can't run one persistently. And where that has happened, then you have had bankruptcies at the municipal level, like Detroit and a few other places. You could conceivably have bankruptcies at the state level, although I don't think we've had any in recent times. So while municipal bond market is important, there are real constraints on how far states and municipalities can go in terms of running budget imbalances. They can't go really very far.
Here's a question I really wanted to know from where you sit in Minneapolis. You wrote this book on Too Big to Fail, and it seems to be an area that you have a very strong opinion on. Are you looking at the topic of too big to fail from here looking there, as in the big banks all in New York? And are you Main Street looking at New York when you think about it?
Not really, because first of all, U.S. Bank is headquartered in Minneapolis, and it has probably got something like the 5th largest balance sheet in the country. So it is a big bank size-wise. It's pretty much a plain vanilla bank when it comes to the activities and businesses it engages in. But I'm really coming at the too big to fail issue not from a Main Street versus New York perspective or something like that. It's really from a public policy perspective, because what the problem with too big to fail is it misallocates both financial and real resources in the economy. It adversely affects economic performance, meaning that if it didn't exist, you could have better economic performance. And it also has tended to, it distorts incentives, and it has tended to burden the U.S. taxpayer, because what it means is you wind up protecting uninsured creditors of these large institutions. So it's a public policy, very important public policy issue that can and should be addressed. There are, I would add, if you wanted to be optimistic, there are some things in the Dodd-Frank legislation that should, if implemented, help to address it, maybe address it quite effectively. But the jury is still out as to whether those parts of Dodd-Frank will be implemented effectively and will serve to diminish and rein in too big to fail.
But still, if I push this question a little bit more to you, the Main Street banks generally have been holding out well. In fact, they are honest to goodness, U.S. Bank, Wells Fargo. The real story is that they've held out well even through the
Right.
economic crisis.
Right.
It's the trading book and it's the capital markets that distorts the business of banking. In fact, it even distracts the business of banking because the business of banking is very cost-driven, it's very distribution-based, all of that. It originates the business, and then it all blows up on the capital market front. So I think that Dodd-Frank tries to ring-fence the different business models. Is that how you would describe it, or?
Well, there's certainly parts of Dodd-Frank, the Volcker Rule, and some other parts of Dodd-Frank that try to ring fence. But I actually think the key part of Dodd-Frank, from a too-big-to-fail perspective, is the so-called resolution and recovery plans, or living wills. That's where, if done right, and that's mandated. It's not that anybody has a choice. The supervisors and the banks the banks have to prepare them, the supervisors have to sign off on them, and it's mandated. That's where the rubber really hits the road when it comes to too big to fail, in my judgment. But as I said before, so far the living will plans seem to be imperfect at best. They have not been approved by the regulators, so to the best of my knowledge. So there's still a lot of work to be done there. But I think it's important to bear in mind, while I would agree with you that where the problems have arisen on kind of the wholesale and more and more innovative parts of the banking business, it's really it's really a question of incentives, and it's really a question of getting banks so that the risks they take are appropriately priced. That's the way I would put it. There's nothing wrong with trading derivatives per se, as long as the risks are, or any other innovative activity, as long as the risks are appropriately priced. After all, banks have to be responsive to their customers, and if they have a demand for or supply of derivatives and customers expect them to make markets and to position, I mean, that's all well and good as long as risk is appropriately priced.
Well, the risk being appropriately priced in the capital markets is a different thing from saying that risk are appropriately priced on the product front. When you price risks correctly for a mortgage business and how that mortgage portfolio gets traded up, the argument, for having a strong capital market to take that off the books of the bank is that it makes it cheaper, it makes it more available to more people, the bank's able to take on more risk and so on. Isn't it also really a leverage issue?
Well, here's the issue, and I would back up a step. So let's suppose I'm a potential customer of a bank that is perceived to be too big to fail. So then since I'm not worried about losing my deposit, because I believe I'll be protected under all circumstances, I'm willing to give that bank my deposit at a lower interest rate than I would for a small institution that might fail. That's just incentive. And that's the problem. So now the bank has cheaper sources of funds than it otherwise would have, cheaper sources of funds than it should have if risk was appropriately priced, and that means it's going to go out and either engage in activities that, if risk was better priced, it wouldn't, or engage in those activities to a greater extent than it otherwise would. It'll become bigger than it otherwise, because again, risk is priced too low. So the banks get bigger and or riskier, or both, bigger and riskier than they otherwise would. And it really doesn't matter whether it's a consequence of the mortgage market or some other market. It's a general phenomenon. And that's why, from my perspective, I start with incentives and pricing. Because after all, the U.S. is a market economy. We generally leave decisions to the marketplace. People buy and sell depending on the prices they confront and the goods and services they want and how they value them. There's no reason to not let that work in finance when you get pricing right. If you don't have pricing right, then you have to, that's why you have regulation, that's why you have supervision, that's why you're going to have resolution and recovery plans. The issue is all of that going to be sufficient at the end of the day to make up for poor pricing? And right now, we'll see.
Now, on the nuts and bolts of something like that, it's incentives. It's also controls in a way. I remember I was in San Francisco just before the crisis hit, and someone tried to originate a mortgage loan with me, and she gave me this form to fill in, and it had this column that said undocumented income. And as for someone who lives outside the U.S., I had no concept of what this undocumented income means, because in most other jurisdictions, you go to jail when if you declare income falsely and stuff like that. So the origination process and the way in which the originators were incentivized is something that a regulator can do something about.
Yes, I agree, and I think there's at least two messages to what you just described. One is that clearly there were excesses going on in the mortgage market. I mean, there were so-called no documentation loans. There were clearly some falsification of income in some cases. Now, that's fraud, and that can be prosecuted.
And nobody was prosecuted.
Yeah, well, right, or not as many people as people think should have been. I leave that to the lawyers. I'm not a lawyer, and I can't say anything with real substance there. But clearly there were excesses going on. The other thing I would say is, some of that may have been occurring because, home ownership has long been an objective of policy in the U.S., not banking policy per se, but of policy more generally. And that's another example of, somebody who had a good idea, but it got carried too far. I think there was a view at the time, you learned the hard way, that while home prices could decline in specific geographic locations, they weren't going to decline nationwide, but of course they did. But I wouldn't try to defend any of that in any way, shape, or form.
Right, and that begs the question in terms of the relationship between the regulators. You have the Fed, you have the FDIC, and so on. So how would you describe that relationship? And do you have an opinion on some form of streamlining of regulation, as it were?
Well, I think that some streamlining would be a good idea. I think it would make regulation more efficient and more effective, and so it should be considered. But it's not a new issue. It's an issue that has been on the agenda in the United States for decades. It's never been able to be accomplished. I think for a couple of reasons. The regulators protect their turf, and the public doesn't care. I mean, the public, you start talking about FDIC, Federal Reserve, OCC, SEC, CFT, the public has no idea about that, nor should they really have to worry about it. So there's no real interest at the grassroots level in a topic like that.
Right, but at the same time, at the technical level, there are prosecutions that fail because it falls between the cracks.
Yeah, no, I agree with you. I think, we should, if we can, find ways to make the regulatory system and structure and the supervision that goes with it more effective and more efficient. I agree with that. But it's all I'm saying is while it's easy to agree on that objective, it's very hard to implement that on the ground.
So that brings us back to this whole point of too big to fail and your opinion on too big to fail, because your interest in banking, as it were, is more macroeconomic and the systemic influence rather than the business of banking.
Mm-hmm.
Would I be able to say that? Now let's just move on very quickly to how the Fed thinks about the U.S. economy and to what extent it's mindful, and sometimes we have this suspicion it's not that mindful of the international dimension of, the Fed sort of sticks to its mandate almost, to the skin.
Well, let me try to describe it, because I think the Fed gets a bit of a bad rap there in the following sense. I attended open market committee meetings not just when I was president of the Fed, but of Minneapolis Fed, but also research director there. So I attended meetings for about 27 years. And I can assure you that the Fed devotes a lot of resources to understanding what's going on in economies abroad, that is, economies other than the U.S. economy, in how markets are performing abroad, in what some of the really major risks and opportunities are. A lot of resources are devoted to that and are discussed at open market committee meetings. But the Federal Reserve is the central bank of the United States and not the central bank of the world. And so obviously U.S. considerations have to play the preeminent role in Federal Reserve decisions. Now, I would say much of the time, maybe almost all the time, there's really not a conflict between what's good for the U.S. and what's good for the world because, because of the U.S.'s size. I mean, the U.S. is so big, the economy is so large that, it matters a lot. If the U.S. economy is doing well, that's going to help the rest of the world. That's going to help the global economy. If the U.S. economy is struggling, that's going to adversely affect the rest of the world. And so there really isn't, in my view, much of a conflict there. Now, there may be circumstances where somebody says, well, you raise interest rates, that's going to be bad for commodities and a variety of developing economies or something like that. And, there may be some truth to that, but that's kind of unavoidable. I mean, I could make the following argument right now. The ECB is being very accommodating. They've adopted quantitative easing. The euro has been declining relative to the dollar. I think that was the intent of the policy, or one of the intents. That's other things equal. That's good for the European economy and not good for the U.S. economy. But I don't think it would make any sense for the U.S. to say, well, stop doing that because that's bad for us. It's important that Europe does better. And if this helps them do better, I'm willing to say over time, that's going to help most of us, maybe all of us.
Right, but when you talk about the U.S. QE in itself, I can argue that the real beneficiary of the whole QE exercise, QE 1 and 2, was the international market because there was so much of a lack of confidence in the U.S. market itself that a lot of the capital actually flowed out. And it actually also changed the balance sheet of a number of central banks outside in terms of how much U.S. debt they were holding. And the house in the neighborhood where I live, the house, insofar as foreigners were able to buy, prices jacked up, and a number of countries had to put holds on hot money flows as a result. So the money flowed, globally, and it didn't really have the impact that it should have had on the domestic economy in the U.S.
Well, actually, I think it probably had the impact in the U.S. that it should have been expected because, if you think about what quantitative easing was likely to do, it was likely to have its principal effect on asset values. Equities, bonds, et cetera, et cetera. And so to the extent that asset values improve, balance sheets are strengthened, you get so-called wealth effects. But wealth effects are known to be, from a wide range of economic research, small in magnitude. So I think what you got out of quantitative easing in the U.S. is what should have been expected. You got small positive effects because wealth effects tend to be small and positive, and that's what we got. It may be, and certainly some of the rhetoric suggested, that people thought the effects would be greater, they would be larger. But my argument would be that if you really thought about it and you really focused on what quantitative easing was likely to accomplish, the effects were going to be modest.
But let's drill down a little bit more on that. I was trying to read the literature on the way in which you voted in the FOMC. I couldn't tell. Are you a hawk or a dove? And there's a kind of a consensus dynamics building in there that even if you had your own opinion, you sort of you sort of gravitated to the consensus.
Well, let me say I dissented, I think, over my career 4 times, which is not a lot, but it's not zero. So I dissented when I thought that policy was going down the wrong path from my perspective, and I had a good reason why we ought to do something different. You never want to dissent just to dissent. I mean, that's not constructive in any way. So you want to dissent where you think you have a good reason to dissent. I was a voter from every 3rd year, but albeit from 1985 to 2009. If you think about most of that period, The U.S. economy expanded uninterruptedly from late 1982 to 1990. It expanded uninterruptedly again from 1991 till about 2000. There wasn't a lot to dissent about. That performance was really quite good. As a policymaker, I think the first responsibility is, sort of do no harm. Things were going along nicely. Inflation was declining and ultimately became relatively low. So there wasn't a lot, in my judgment, there wasn't a lot. If you take a look at that period, there wasn't a lot to argue about. Even in the first part of the previous decade, from 2001 to 2005, for the most part, things were, maybe it'd have been nice if the economy was growing a little more rapidly, but overall, it wasn't a bad performance. Yeah. You remember the great moderation. Right. Well, that's the period of the Great Moderation.
Yeah, at the same time, that was also the period that the monsters were building out outside the banking industry. You allowed it.
Having said, I won't disagree with you, but I will point out that economists and policymakers, central bankers, have debated for a long time about whether policies should try to deflate asset price bubbles. And the consensus has been, the answer to that is no, because it's too costly to the macroeconomy to do so, that the appropriate policy is when the bubble bursts, then you try to contain the damage, limit the damage. And that's been, I think, based on cost-benefit considerations, that's been the accepted conclusion on that kind of issue. Now, shortly before I retired, I wrote a short essay saying, I think we need to rethink that. I think we need to think about maybe monetary policy should look to deflating asset price bubbles because of the cost of the last financial crisis. Maybe the cost benefits aren't quite what we thought. I don't know that issue is being debated very actively at the moment, but from my own perspective, I will say that, I think central bankers, in thinking about stability broadly, need to worry about asset price excesses, bubbles if you want to call them that, and what, if anything, they can do about them at reasonable cost. You've got to be able to, first of all, identify them, and then the cost, and what's the cost of dealing with them.
Right. Now, that begs the question, and I never thought the U.S. would get to this, but this whole practice of inflation targeting, right? I don't know that it's a healthy regime because it further incentivizes central bankers to define their own mandate. It's like, this is my job description, and that's what you tell the politicians. And
well, I would again, I think it pays to remind ourselves where that comes from, and where it comes from, at least in an initial sense, is the experience in the 1970s and early 1980s of double-digit inflation in the United States, of the Federal Reserve, many officials in the Federal Reserve saying, there's nothing we can do about this. It's not a monetary policy issue. It's cost push, et cetera, et cetera. And then Paul Volcker became chairman and demonstrated not only could monetary policy do a lot about it, it did something about it. And it set the stage, in my judgment, for the very good economic performance of the balance of the 1980s and the 1990s. So I think, and of course you've got the Milton Friedman intellectual origins of inflation being a monetary phenomenon. So I don't have any quibble with price stability as an objective. I do think people ought to ask themselves, does it really make any difference whether inflation is running at 1.5% or 2%? For my judgment, it can't possibly, in an economy like the U.S., matter. So the fact that, the Fed is a little below the 2% target seems inconsequential to me. My guess is that at least some people in the Fed might agree with that, but they would say, yeah, but the concern is that it might go a lot lower than what. It's not that it's 1.5 rather than 2. It's that it's 1.5, and we're worried it could go a lot lower. That raises a whole other set of issues that it gets us into other topics.
It's one thing for the economists and the media to sort of speculate what the Fed's going to do and where they're going to take it. It's another thing for the Fed itself to give this thing called forward guidance, Here's where we're going. Let me have a look at your palm, and I'll tell you what your history is going to be. And it adds an entire new dimension. You're asking to be evaluated on something which, it's like putting yourself into a prison and saying, this is where I'm going to be sitting.
I think forward guidance has been well-intentioned and was designed to anchor expectations earlier in the aftermath of the financial crisis so that participants in the U.S. economy could count on low interest rates for an extended period of time. I think that might have been their language, and make economic decisions accordingly. I don't think it has worked out, at least in recent years, as well as hoped. And I think the Fed may be, but whether they are or not, I think they should review the whole communication guidance approach and decide, and improve it where they can. You'll never be able to, if you're the Federal Reserve, you'll never be able to give market participants all the information they want, because what they don't want to just know what are you going to do at the next meeting or the next 3 meetings. They want to know what you're going to do over the next X years under all possible circumstances, and nobody can do that. And so there will always be dissatisfaction.
Right. So what did it do to the FOMC when they were going that way? And are they pulling back on it?
Well, I don't know whether they're pulling back on it. I think we'll see. I think, as I indicated, I think there should be a very thorough review of it. It also, if they decide that there are improvements that can be made, but transparency is a one-way street. Once you decide to provide some information, you're providing it. You can't decide a couple of years later, well, that was nice, but we're not going to provide that information anymore. People will be very unhappy about that. So it's a one-way street. I think they have to be careful. I think they need to review this. I think they have to be careful if they decide they want to make changes. They got to bear in mind the changes may not be permanent, but they won't go away easily.
Because the difference in being an FOMC member today and, say, 20 years ago is that the number of instruments that you affect as a result, asset classes that you affect, is really is wide and broad and deep. And so in that when you provide guidance, you don't know what the market's going to be attacking. Like in Europe, it attacked, government bonds. And in countries where banks were capitalized or were funded using government bonds, that had an adverse effect. In the U.S. it will be a lot different. It's a different capital market.
I think that's a fair point, and I think the implication of that would seem to be, to me, that you want to make your changes very cautiously and carefully from here. It's sort of the law of unintended consequences, because you're never going to be quite sure of all of the ramifications and all of the implications that might come forward. And it might also not be a bad idea. I don't know that this ever would happen. But, the Fed, the chair is still the principal spokesperson. And I think everybody in the marketplace understands that. But it's also true that most other Federal Reserve officials are relatively outspoken these days. I'm not sure that has turned out to be all that helpful. Now, I believe in freedom of speech, et cetera, but, maybe part of the reason that guidance hasn't worked as well as it might have is that, it hasn't been well delivered.
And what does it mean to be an economist today? When you were entering the workforce, what did you perceive the job description to be, and what has it turned out to be in the end?
Well, that's a fascinating question. And when I joined the New York Fed, which was my first job out of graduate school, I was an economist B. That was my title. So not a very exalted title. And I thought I would stay there for a few years and then go into academia, because in the U.S., if you get a PhD in economics, most of the time you're thinking about an academic career. As it turned out, I really liked public policy, and so I'm glad I was able to, spend the bulk of my career, at least, at the Federal Reserve, because if you're an economist, that's the best place to be in public policy in the U.S., in my judgment. But, you know, if I go back to the way you phrased the question, you know, the nice thing about being an economist is you have lots of different opportunities. You can go into public policy, you can go into academia, you can work on Wall Street or consulting and so on and so forth. You've got a lot of skills that are marketable. And so I think then it boils down to, you know, what do you enjoy doing and where do you think you can make a contribution and so forth.
Your successor at the Minneapolis Fed, you know, recently said that he's not going to seek a,
Yes.
You know, was your thinking at the time that you were looking for successors that you know that your successor will follow in your footstep and serve a long and distinguished career?
You know, I personally didn't have a presumption about that, and I was involved very little in the search process. And, you know, if he'll stay through the end of his current term, which will then be like 6.5 years, that's not that short a period of time. It's obviously a lot shorter than I stayed, but, you know, perhaps I was at it for too long. And anyway, you know, he obviously has decided that, you know, he wants to move on and undertake other things, and, you know, that's great.
Maybe that's what, you know, Federal Reserve Bank presidents should do, because there are a lot more career opportunities, you know, after you leave the Federal Reserve Bank. And
No, there are, and I think you need to. It goes back to what I say before. I mean, I think you need to weigh the opportunities. What do you like to do? Where can you make a contribution, et cetera, et cetera. Obviously, you know, some people like me love being Reserve Bank president. Some people never enters their mind. That's not what they want to do, no matter what. And that's, you know, that's fine.
thank you very much for speaking with us today.
Good to see you.
Cheers.